This is Mr. Liao, and this is the first part of our macro FRQ review. I'm going to go over the handouts, which cover questions from 2007 and 2006 version B. So 2007, number one, assume that declining stock market prices in the U.S. cause many U.S. financial investors to sell their stocks and to increase their money holdings. Draw a correctly labeled graph of the money market and show the impact of the financial investor's actions on each of the following: demand for money and nominal interest rate. So we have the money market graph. The x-axis is the quantity of money. The y-axis is the nominal interest rate. Downward sloping money demand curve, vertical money supply curve. R1 is our initial interest rate, M1 is our initial quantity of money. So with the financial investors wanting to sell their stocks to increase their money holdings, that's going to increase their demand for money. So the money demand shifts to the right, increasing, which increases the nominal interest rate. So demand for money, Roman numeral 1 increases, Roman numeral 2 nominal interest rate also increases. All right, part B, due to the decline in wealth caused by the change in stock prices, the general price level in the U.S. falls relative to the price level in Japan, a trading partner. Use a correctly labeled graph of the foreign exchange market for the US dollar to show the impact of the change in relative price levels on each of the following. So we had demand for the dollar and the price of the dollar in terms of yen per dollar. Now, of course, on the 2020 AP exam, they will not be covering foreign exchange, but you can look at this anyway. So we're going to look at the dollar graph. So the y-axis for dollars is going to be expressed in yen per dollar. That's the exchange rate. And the x-axis is the quantity of dollars. So let's start with this, supply of dollars and the demand for dollars. We have an initial exchange rate, which we'll call E, initial quantity of dollars, which we'll call Q. So with the general price level in the U.S. falling relative to Japan, that's going to make American goods seem more attractive to Japanese buyers. So Japanese buyers are going to demand more dollars to procure those cheaper American goods. That's going to increase the demand for US dollars to the right, which would then increase the price of the dollar in yen per dollar. So that's going to make the dollar appreciate in value, which is the price of the dollar. So again, demand shifts to the right for the US dollars because of the lower price level in America. Japanese buyers are going to be lured by the now relatively cheaper American goods, increasing their demand for dollars. Part C, how will the change in the price of the dollar you indicated in part B2 affect net exports of the United States? So now that the exchange rate has gone up, American goods are now relatively more expensive. Thus, American exports will decrease. So American goods are now more expensive. American exports go down. Now, you might be confused because you might be thinking in part B, wait a minute, American exports are going up because Japanese buyers want more American goods. Well, this is the nature of these problems, is that whenever you have a change, you might have a subsequent change, and the question will hone in on one impact of that subsequent change. Here they want you to basically address net exports due to the increased exchange rate of the dollar. Part D, using a correctly labeled AD and AS graph, show how the change in net exports in part C will affect each of the following in the short run. We have aggregate demand, then output and price levels. So in part C, we concluded that net exports decreases. Here's our initial aggregate demand, aggregate supply graph, downward sloping AD, upward sloping SRAS, vertical LRAS, an initial price level and initial output level. You actually don't have to have LRAS. This does not require you to start at long-run equilibrium, but I just start there anyway. So since net exports decrease, that's going to result in a shifting to the left of aggregate demand because net exports is a component of AD. AD shifts to the left, therefore AD decreases. As a result, output and price level also decrease. Part E, given your answers to Part D, what will happen to unemployment in the short run? Explain. So since real output has decreased, unemployment will increase. Remember, unemployment and real output are inversely related. 2007, number 2. In recent years, the Federal Reserve has made targeting the federal funds rate a main focus of its monetary policy. Part A, define the federal funds rate. The Fed funds rate is the interest rate on short-term loans between commercial banks. So remember, the discount rate is the rate that the Fed offers its commercial banks. The federal funds rate is the rate banks offer each other. So remember, discount rate is like daddy offering a loan to the kids, and the Fed funds rate is like the kids or friends loaning money to each other. So Fed funds, friends, That's one way to remember. B, if the Federal Reserve wants to lower the Fed funds rate, what open market operation would be appropriate? So remember, open market operation means buying or selling bonds. It's not adjusting the reserve requirement. It's not adjusting the discount rate. So the answer is to buy government bonds and securities. So government bond securities will increase the money supply, thereby lowering the the nominal interest rate, which ultimately leads to the lowering of the federal funds rate. C, assume that the open market operation that you indicated in Part B is equal to $10 million. If the required reserve ratio is 0.2, calculate the maximum change in loans throughout the banking system. So the spending multiplier is 1 over the required reserve ratio, which is 0.2, so the spending multiplier is 5. So the total change in the money supply is going to be 5 times $10 million. That entire $10 million is new money into the money supply. Now the thing is, with that 50 million bucks, it's going to be deposited into banks. Here's where the required reserve ratio comes in. $10 million of that 50 million is going to remain as required reserves, which means $40 million is going to be the maximum change in loans. D, indicate the effect of the open market operation that you indicated in Part B on the nominal interest rate. So the graph wasn't needed. You didn't have to do it, but I'll do it anyway. So again, vertical money supply, downward sloping money demand, and with the buying of bonds, that increases the money supply, which lowers the nominal interest rate. So the answer is to lower the nominal interest rate. You did not actually have to show the graph to get credit. E, assume that the Federal Reserve's action results in some inflation. What would be the impact of the open market operation on the real rate of interest? Explain. So remember, the real interest rate is equal to the nominal interest rate minus inflation, and you're told the inflation rate goes up. You were also shown that in Part D that the nominal interest rate goes down. So what would be the impact of the real interest rate? Well, the nominal interest rate falls and inflation goes up. So therefore, the real interest rate has to go down because the nominal interest rate is causing the real interest rate to go down. Inflation is going up, which causes the real interest rate to go down even more. So real interest rate must fall. Let's go to 2006B, number 1. Assume that the country's economy is operating at less than full employment. A, draw a correctly labeled graph of AD and AS and show each of the following: the LRAS and the current output and price level. So you have price level on the y-axis, real output on the x-axis. It is LRAS, and you have what's called a recessionary gap. Short-term equilibrium is below potential GDP. So SRAS and AD intersect at a level below LRAS. There's your initial price level. There is your initial level of output. It is below full employment. B, assume that policymakers take no policy action and that prices and wages are flexible. Explain what will happen to each of the following. 1, short-run aggregate supply. SRS is going to shift to the right or increase due to the wages decreasing due to lower costs of production. So lower cost of production, if you leave an economy alone, SRS is going to shift back towards full employment. So SRS shifts to the right. Now let's see what happens to employment. Well, since real output increased, that's going to increase employment. Notice it asks about employment, not unemployment. So employment varies directly with real output. C, now assume that instead of taking no policy action, the government implements a special tax incentive to encourage individuals to increase saving for retirement. Draw a correctly labeled graph of the loanable funds market. Show how the real interest rate is effective. So they gave you the real interest rate, so that's what you're going to put on the y-axis, quantity of loanable funds on the x-axis. There's our initial equilibrium. Because of the special tax incentive to encourage individuals to increase saving, an increase in savings increases the supply of loanable funds. Thereby, the interest rate, the real interest rate, goes down. D, given your answer in Part C, explain how aggregate supply is affected in the long run. Since the interest rate has gone down, lower interest rates are going to increase investment, which increases capital stock, which leads to long-run economic growth, thereby shifting LRAS to the right or increasing it. Number 2, banks play an important role in determining changes in the money supply. Assume a bank receives a cash deposit of $9,000 from a customer. What's the immediate impact of this transaction on the money supply? So there is no immediate impact because the original $9,000 was cash. It was already in the money supply. It just changes its character within M1. It becomes a demand deposit, but only the composition of the money supply changes. The actual money supply value or amount itself will not change due to this cash deposit. Part B, suppose that the reserve requirement is 10% and banks voluntarily keep an additional 10% in reserves. Calculate each of the following. So we have the maximum amount by which this bank will increase its loans from the transaction in Part A. You effectively have a 20% reserve ratio because the Fed mandates that they hold 10% and they choose to hold 10 more percent. So total 20%, which means the bank can loan out 80%, which is $7,200. That's how much they can loan out. Part 2, the maximum increase in the money supply generated from the transaction in Part A. Now, even though the reserve requirement is 10%, it's an effective 20% reserve ratio. So banks are going to keep 20% of all their holdings, loan out of the 80%. So the effective money multiplier is actually 5. So it's $7,200 times 5 or $36,000. That's the maximum increase in the money supply from Part A. C, assume that the government increases spending by $9,000, which is financed by a sale of bonds to the central bank. What will happen to the money supply? Well, the money supply is going to go up because the government sold bonds to the central bank. Notice the government spending increases, the government selling bonds to the central bank, which means the central bank is actually buying bonds. So read the questions carefully, because just because it says sale bonds, don't automatically think, oh, money supply is going down. You have to see who's selling the bonds, who's buying the bonds. Here, the sale of bonds is to the central bank, which means the central bank is actually buying bonds. Money supply goes up. Very tricky. What will happen to the money demand? Money demand will increase because income will increase. So real GDP increases. That is one of the shifters of money demand. So money demand goes up. Number 3, and this is a foreign exchange problem, so if you want to skip it, that's fine. Assume that South Korea and Canada are trading partners. The equilibrium exchange rate between the Canadian dollar and the South Korean currency, the won, is shown in the graph of the foreign exchange market to the right. Part A, explain how each of the following will affect the demand for the Canadian dollar. Notice the question is asking about demand for the Canadian dollar. Part 1, the inflation rate in Canada is higher than the inflation rate in South Korea. Since the inflation rate in Canada is higher, the demand for Canadian dollars will decrease because South Koreans are going to buy fewer Canadian goods due to the higher inflation rate in Canada. Therefore, they will demand fewer Canadian dollars. Roman numeral 2, real interest rates in Canada fall relative to real interest rates in South Korea. You're going to have the same result. The demand for Canadian dollars will decrease because money is going to flow to the higher interest rates. So South Korean investors are going to demand fewer Canadian dollars because they are less likely to invest in Canada now because of the lower interest rates, which means a lower rate of return. Part B, given your answers to Part A2, indicate how the value of the Canadian dollar is affected. So the Canadian dollar will depreciate. Since the demand for the Canadian dollar goes down, you can imagine this graph where demand shifts to the left, which lowers the price level, or lowers the quantity, but also lowers the exchange rate. So the Canadian dollar effectively gets weaker or depreciate because the demand for the Canadian dollar goes down. C, as a result of the currency change in Part B, what will happen to Canadian exports to South Korea? So we know that the Canadian dollar is weaker, so Canadian exports to South Korea will increase. Because the Canadian dollar is weaker, now Koreans will find Canadian goods relatively cheaper. They're more likely to buy from Canada. So those are the review problems we went over. If you have any questions, you can let me know.